Hello everyone. I hope everybody is fine. So we are starting with business valuation today, and we'll also be covering the risk management part of the syllabus. A quick introduction to the topic, business valuation. What is business valuation? As the name suggests, it's the process of valuing a business. For example, if I have an organization, I have a company, and I want to find out the worth of that company. That process is called business valuation. It may be my company, it may be someone else's company that I want to value. So the process of calculating calculating worth of a business is called business valuation. Now, as you know that whenever we do something, we have objective of doing something. So what will be the objective of business valuation? Why we would like to value a business? One of the reasons why we will be valuing a business is maybe we are looking for a loan. We are applying for a loan, and maybe because of the loan, it is a requirement that we should value the company. So one of the reasons why we will be doing a business valuation. Another reason may be merger. We may be merging one business with another, merger. Third, it may be acquisition. Maybe we are acquiring a business, acquisition. Maybe we are going to a stock exchange. Maybe we are going for listing. Or maybe the original owners looking for realizing their share. Maybe any of the owners or partners in the business, they want to value the business and they want to take their share away. They want to realize their share of the business. So these are probable reasons why a business would be going for, why somebody will be valuing a business. So what are the methods of valuing a business? Well, we have different methods of valuing a particular business. We have asset-based models. In the asset-based models, we have we have book value basis. We have realizable value basis, and we have on replacement basis. What do these methods mean? We can value a business based on the assets that we have in the business. For example, a business has non-current assets, including building, equipments, machinery, vehicles, or fixtures, furniture. Non-current assets, let's say these assets were purchased for, let's say, $1 million, and up till now we have charged a depreciation of, let's say, $200,000. So we'll deduct it, so we'll get the book value of the non-current assets. Then we may have current assets in the form of inventory, the form of receivables, or probably the prepayments, let's say. So let's say 200,000 of current assets. So if we add these two, the total assets will be $1 million. And that's the value of the, that's the total value of the assets. Now the net worth of the business will be after deducting the liabilities from these assets. Then you will come to know the net worth of the business if there are liabilities as well. So from 1 million we have to deduct the total liabilities of the business. We will get the net worth. If we use these book values, the cost minus depreciation model to value a business, that is called book value basis. But remember one thing, no one practically uses this method. It's just a theoretical method. No one will use this method to value a business, and the reason is it's it, when we prepare balance sheet, we prepare it on the basis of a going concern that it will be continued. The business is going to be continued. So it's on the balance sheet. If we are using going concern, there is no harm in showing the assets on their book values. But when you are selling a business to someone or you're trying to find out the value, nobody will look at what price you purchased your assets or how much depreciation you have charged so far. So nobody will care. Just take an example. If you have a cell phone and you have purchased that cell phone, let's say for let's say $300. Now you are trying to sell that cell phone after using it for through 2 months or 3 months or 4 months. And if you're selling it to someone, that someone will not, he won't care at what price did you buy. He will be looking at its current price. So nobody's looking at the historic price of the assets. So practically speaking, this method cannot be used for business valuation. So you may explain it from a theoretical perspective, but remember to mention whenever you are discussing a business valuation model that this model is not practically used. Then comes the realizable value basis. Realizable value means forget about the historic value of this asset. Just check it out. If you want to sell this asset today in the market, what will be the value of this asset? It may be more than this, it may be less than this. So when you calculate the current market values of your assets, including inventory, it is called realizable value method. Even this method is not used because if you are selling a business, there's a big difference between selling your assets or selling a business. A business will have its goodwill, will have its brand name, will have its brand value, will have intellectual assets. There may be assets that are not shown on the balance sheet. So no one is going to sell a business equal to the value of its assets, especially if a business is making profits. So this realizable value method can be used in a rare case, especially when a business is making losses. In that case, it may be sold on the basis of the assets that it has. But it's a very rare case. So it can be used. I'm not saying it's theoretical. It is a practical model, but a very, very rarely used practical model. Then comes replacement value basis. The replacement value basis is not basically used for the whole company. It will probably be used for a few of the assets. For example, if you have fixtures in your company installed, and you know that most of the fixtures, when they are they're dismantled, they lose their value. For example, you have just recently renovated your office and you have done wooden flooring in all of your office, but you know that when you dismantle that floor, it will have no value. So that does not mean that if you are valuing your business on the basis of the assets, you will charge no value for that flooring, or you will charge no value for the ceiling, the fancy ceiling that you may have done. Or sometimes it's even the split AC units. Even if they are new, they've been newly installed, but when you try to sell them, they are being sold at a very at a lower price than you have bought. So usually these type of assets, they are valued on the basis of replacement. That is, if you are going to buy a similar type of asset today, how much it is going to cost you, rather than you valuing it on the basis of its realizable value. That is, what will be the value if you are selling the existing asset. We do it the other way around. We just value it on the basis of assumption that what if we are going to buy a similar asset today and install it, how much is it going to cost us. So that is called a replacement value basis. Okay, there is a question from Abdul Rahman that he's asking that, sir, can you repeat the realizable value method? Realizable value method means when you are valuing your assets on the basis of their net realizable value, that is, at what price they will be sold, at what price these assets will be sold today. That should be considered the value of those assets. Yes, a fair value of assets, basically it's the asset based model. So these are the asset based models, are very rarely used, these models. Okay, then we have another category, that is the earning based models, valuing a business on its capacity to generate earnings, most commonly used one. So earning based model, one of the methods under this category will be the PE ratio, price earning ratio, PE ratio, or earning yield. These both are both of these methods are the same. Earning yield. The another one is the dividend valuation or dividend growth model. So PE ratio method, what is PE ratio method? A quick understanding of a PE method. PE is price earning ratio. For example, if a company has a company's, let's say we have a company A which we are trying to acquire, and we want to find out the value of this company A. So this company is called target company, and we have a similar company in the market which is called company B, and we call it proxy company. We call it a proxy company. We have nothing to do with this company, but it's a similar to the company A, and it is a listed company. Whereas I'm just assuming that A is not a listed company, let's say. So we picked up this company because a listed company has one good quality, and that quality is that it has a price. It has a share price, and you don't need to value this company because you will already have its price in the market. So you can just Google, and if you want to find out the share price of Apple Incorporated at the moment, you can just simply Google it and search it on the web and find it. The value will be right there. So that listed company, we've picked a listed company, and we're calling it a proxy company. Now let's say the listed company has a market price per share. Let's say it has a market price of, say, $10, right? And we don't have the price for this company, so let it be. Then we have earning per share. We can have earning per share for both the companies, whether if it's a listed or not. Definitely the income statement will be prepared for both. So let's say earning per share of this company is $2, and okay, let's have it $3. And the earning per share of this company is $2, right? So a PE ratio, we don't have a P ratio for this company because we don't have a price of this. So a P ratio of this company will be price divided by earning. So 10 divided by 2, it is 5, which means that the investors of B company, they are willing to pay a price which is 5 times of the earning of the company. This company is giving an earning of $2 every year on a per share basis, and its investors are ready to pay 5 times of this earning as a value of the share. So the investors are willing to buy a share for $10 that is generating $2 earning every year. So the PE ratio is 5 times. We can also find out the earning yield of this company. Earning yield is basically when you calculate the return. Earning yield is basically the return. So if this company is generating $2 earning against a $10 investment, what is the percentage return? Who's going to tell it? What is going to be the percentage of return? This investment has a value of $10 and it generates a return of $2. It's a 20%. That's what earning yield is. It's 20%. 2 divided by 10, 20%. So earning yield is basically your EPS divided by MPPS. You're just trying to find out how much in percentage terms you are earning. So that's, you can call it a return on equity as well. $2 divided by $10. Okay, so 20%. Okay, so I just studied this B company. I found that it has a price of $10. It has an earning of per share of $2, and its price earning ratio is 5 times. That is, the investors are willing to pay 5 times against the earning. Now the earning of this A company, which is a similar company to B company, right? Which is a similar company to B company, to B company. So if it is generating earning of $3, so what do you expect the investors to pay for this company? If they are willing to pay 5 times of the earning to B company, how much they will be paying to this company? Everyone. I'm waiting for everyone's answer. If it has an earning of $2 and the investor is ready to pay 5 times, that is $10 against this earning, then how much they will be willing to pay for this company? 5 times, right? 5 times, right? 3 into 5. The earning per share into 5, $15. So being a similar company to B company, we expect that the investors will pay 5 times of its earning as a price. So we've got the price. That's called the PE method of valuing a company. So we've got the price of this company 5 times. So the formula for calculating market price per share using the PE ratio will be EPS, earning per share, multiplied by PE ratio. That's the formula for calculating the value of a company using PE ratio. But the PE should be of a proxy company, of a company that is similar to B company. PE ratio shows PE ratio shows the confidence of the investors. PE ratio shows how many times an investor is ready to pay against a particular earning. So if we have an earning of a company, we can simply multiply with that time to get the value of the company. So since it is generating a higher earning than this company, definitely we expect a higher price, right? So sir, what if we want to use earning yield? We can still use earning yield, right? The earning yield can give us the same formula. We are saying that investor wants a return of 20%. Investor wants a return of 20%. So if it sees an earning of $3, how much it will be willing to pay? So he will be willing to pay an amount whose 20% is equal to $3, right? So simply what you need to do is you just pick this and divide it by 20%. Simply, instead of multiplying it, when it comes to earning yield, we just simply divide to find out that $3 is 20% of what? This is what we need to find out. It's 15. Same. So either you use earning yield or you use PE ratio. They both give you the same answer. They both have the same answer, different way of calculation. EPS divided by earning yield. Rather than multiplying with the PE ratio, you should divide EPS by the earning yield. You will get the same answer, the 15. Let me do it again. 3 divided by 20%, $15. Right? So PE ratio is one of the ways through which we find out the value of a company, but it's a very important thing to note down now. Okay, this is something that you should note. If this is a listed company and this is not, and we call it a similar company, when we say it's a similar company, we just mean the size of the company, not the legal status of the company. So if B company is a listed company and A is not a listed company, we do not expect the investor to have the same confidence on A company as they have on B company, because a listed company, because of regulations on the listed company, because of more strict regulations on the listed company, the investor's confidence will always be higher on a listed company than compared with a non-listed company or unlisted company. Therefore, we don't expect that they will be paying 5 times. So then how will we be valuing it? Well, there is no standard answer to this question. Sir, can we still use PE ratio of a listed company to value unlisted company? We do not have any other way out. We have to do it, but we have to apply a degree of caution. We have to apply a degree of caution. What is that degree of caution? According to this PE ratio of a listed company, the price of this company should have been 15, but only if this company was a listed company. Since it's not a listed company, then usually as a rule of thumb, what we do is we create a range of the price. And the range of price, as a rule of thumb, there is no standard definition that we have to do it. There's no strict rule that we have to do it. But usually what people do is they divide 15 by 2 to get the minimum limit, and they divide 15, or they multiply it by 2/3 to get the maximum limit. So they feel that if a listed company would have been a value of 15, then a similar company of a similar size company but unlisted will have a value between 7.5 to $10. That is half of a listed company to 2/3 of a listed company. Half of a listed company to a 2/3 of a listed company, but that will only be considered value when you are discussing a question, not for an MCQ. Remember, this is only for discussing. When you have to discuss about the valuation of a company and you're using PE ratio and the calculation involves discussion as well, then we should be doing this. Otherwise, for MCQ, the answer should be $15, because this is highly subjective. Few of the investors, they may value it as $10. Few may value it at 7.5, or few may value higher than $10. So it's a very subjective thing. So only do this when you have to discuss. That's it. Asad, unlisted company will have no price in the market. Therefore, we can't calculate the PE ratio of unlisted company. The only way to calculate the PE ratio of unlisted company, or the only way of calculating the price of a listed company, is using a listed company's PE ratio. That's it. %, 80%, 70%, like I took 50% here. I took 66.6% here. Few people may take 80%. That's why I said it's a very subjective matter. They may take 80% of this value, $12. They may take 90. It depends on individuals, but usually it's half to 2/3. Because a listed company is less riskier than an unlisted company. So if somebody is willing to buy, okay, let me give you another example. Let me give an example. If you have to buy a 200 yards house, right? One in a centrally located place of a city where you know that there are so many buyers willing to buy this property. Then you have a 200 yards of house or home in the outskirts of a city or outside the city. Tell me, which one will you value the most? The one in the center of the city or the one in the outskirts of a city? Both houses have the same area, definitely, because of the confidence. The same difference is between a listed company and an unlisted company. A listed company, the share of a listed company will always be valued more than an unlisted company, provided that they both have the same earning levels, right? Because of the confidence that the investors will have on a listed company. So that's why when we are valuing unlisted company with the help of a listed company's PE ratio, we calculate the price and then reduce it by 10%, 20%, or 30% because of that risk factor involved in valuing the unlisted company. So that is the PE ratio method or earning yield method. They both are same. I have written the formula for both. They both give the same answers. Then we have dividend valuation model or dividend growth model. The dividend valuation or dividend growth models, they value the company based on the dividends that the company pays rather than the total earnings. Most of the companies, they earn more and they pay less dividends. And most of the investors in the market who do not look at the financial statements, they usually think the dividend is the income of the company. They usually they have a perception that if the company is paying higher dividend, it means it's making more profits. It means it's a good company. So a general perception in the market will be a higher dividend would mean a high performing company. Therefore, there should be a high value of that company. So dividend valuation model calculates the value of share based on the dividends paid by the company. So the formula for dividend valuation model is price will be equal to dividend divided by cost of equity, K. Dividend divided by cost of equity. Now, why they have divided by cost of equity? Basically, they are actually calculating the present value of the dividends that they will be receiving throughout the life of the company. If you remember a formula for perpetuity formula, annuity divided by discount rate. So here the annuity is the dividend because you will be receiving dividends throughout for indefinite period of time, and the discount rate is the cost of equity. So basically, this price is basically the present value of these dividends that we will be receiving throughout the life of the company, which is indefinite. So present value of the dividends will basically be the value of the share. This is what the assumption is. So let's say, for example, if a company is paying dividends of $5 per year forever, right? And the cost of equity is, let's say, 10%. 10%. Then what is going to be the share price of this company? What is going to be the share price of this company? Who's going to tell me? If the dividend per share DPS is $5, the cost of equity, the return on equity is 10%. Then what's the price? Yes, of course, $50. Because if investors are expecting a 10% return and they're getting $5, they will be willing to pay $50 for this share, because $5 is 10% of $50. So the price of the share will be 5 divided by 10%, $50. So this is what assumption, this is a theoretical model. Dividend valuation model or the PE ratio model, these are theoretical models, especially the dividend valuation model. So the share price of this company predicted by the dividend valuation model is going to be $50. But there are some problems with this model. Number one, which we call limitations. Number one, it has assumed a constant dividend, whereas dividend may grow in the future. So one of the problems with this model. Secondly, it has ignored capital gain. Don't you think capital gain is also a return? It's not only the dividend that you receive, it's also the capital gain. If you hold the share of a company for 1 year, you will get benefit in two forms. One is the dividend for the year, and the other is the appreciation in the value of the share. So the return will be the sum of dividend and the capital gain, whereas they considered income, the dividend valuation model considers dividend as the only income. So this is another limitation. Third, it ignores, okay, it does not incorporate risk explicitly. There is no project specific risk involved. 4, it ignores taxation. So these are the limitations of the dividend valuation model, right? So one of the limitations that it has assumed the constant growth could be removed through another formula called dividend growth model, which is advanced version of the dividend valuation model. And according to that, the price will be equal to D naught into 1 plus G, the growth, this whole divided by K, and whatever answer comes, so D naught into 1 plus G divided by KE minus G. So where D naught is basically current dividend, that is the recent dividend paid. G is the growth rate in dividend. KE, you all know, cost of equity. Now remember an important thing. It should be of the target company. Always remember, the KE used in this formula should always be of the target company and not of the acquiring company. For example, we were acquiring company A and we are valuing company A's share. So we should use the cost of equity of company A, not of our company. Most of the students, they get confused here. For example, our company name is company B, and company B is acquiring company A, and we need to find out the value of company A. But in the question we have been given the cost of equity of company B as well as the cost of company A, cost of equity of company A. So both cost of equities have been given. Which one should we use? We should be using the cost of equity of company A. Remember this. It's a very small thing, but you will lose marks if you do a mistake here. So cost of equity should always be used of the target company, not of the acquiring company. Right? Now, another important point, just note it down. D naught means current dividend, right? Basically, we don't need the current dividend. Whoever invests in the company today will be getting the dividend of the next year, not the current dividend. The current dividend will be paid to someone who has who held the share for last 1 year. That's why we have 1 plus G in the numerator. When we multiply it with 1 plus G, it becomes next year's dividend. We should always use next year's dividend in the numerator. Only if we have the current year dividend in the question and they haven't given us the next year dividend, but they have told us at what rate the dividend is going to grow, then we pick this current dividend and multiply it with 1 plus G to make it the next year's dividend. But if we already have next year dividend, just put that next year dividend without inserting growth. Let me give you example with figures. Let's say we have a current dividend, that is a dividend just paid. Current dividend is, let's say, $4, and we expect that the dividend will grow at 5% rate. So in the numerator, we should not use $4. We should rather use 4 into 1 plus 5%, so that it becomes the next year dividend, $4.2. So in the numerator, we will just write 4.2 instead of D naught into 1 plus G. But if the question has already given us 4.2, the next dividend, we will just simply put it here. So remember this thing. Right? So these were the few points that you should remember. And if you remember in the start of the session, I told you that it's the small mistakes that results in a failure in financial management paper. And these are those small mistakes that usually students make and they lose marks. No, in the denominator, the growth should always be there. KE minus G should always be there. I'm just talking about the numerator. In the numerator, either put $4 with 1 plus G or 4.2 without 1 plus G. But in the numerator, it should always be KE minus G. Okay, now let's start a question on business valuation. So that was a brief introduction of business valuation. So Forbes company, it's a very good question. Forbes company is considering a bid for Denoka company. That's a target company. Remember to highlight target company so that you know what figures to use. So the target company in this case is Denoka company. Both companies are stock market listed companies. Okay, so we have listed companies and are in the same business sector. So, okay. Financial information of Denoka company, which is shortly to pay its annual dividend. It hasn't paid its dividend, but it is about to pay its dividend. Okay. Number of ordinary shares. Okay, this is the information for Denoka company. That's very important, right? So it's the information for the target company. Number of ordinary shares 5 million. Okay. Ordinary shares price 3.3. We already have a share price here, but still we need to find out the value of the company, right? because the question has asked us to do. Earning per share is 40 cents. Proposed payout ratio, that is dividend payout, is 60%. Dividend per share 1 year ago is 23.3. Dividend per share 2 years ago was 22. This information is usually given to calculate growth. Beta is 1.4. Okay. Other relevant information, the average sector price earning ratio is 10. Risk-free 4.6%. Return on market 10.6%. Okay, market return has been given as well. So what we are supposed to do, calculate the value of Denoka company using the following methods: the price earning ratio method and the dividend growth method. So with the help of both methods, we need to find out the value of the Denoka company. Okay, good. Let's do it. Let's first do it using the PE ratio. For the PE ratio, MPPS, market price per share, should be calculated by multiplying the earning per share by the EPS, by the PE ratio of a proxy company. In this case, we don't have any proxy company. There is a straight away the target company, but we have been given with the average sector price earning ratio. We can use that as well, 10, right? So we'll pick 10 and multiply it with the earning per share of the company. Earning per share is 40 cents. So 40 cents and then divided by 100 to convert it into dollars. So 10 into 40 cents divided by 100. Here we go. We've got the share price $4, but it asks for the total value of the company. So the total value will be $4 multiplied by 5 million shares. So it's in millions. So the total value of the company as per PE ratio is $20 million. That's it. After PE ratio, we have to use dividend growth model. Okay, one more thing. Let's go to the question again and see if the question has asked for a valuation model or the growth model. Growth model. Now remember one thing. What if they have shown if they have asked to use dividend valuation model? Now let me tell you this thing. It's again an important thing. No, Daniel. We should still use dividend growth model. I told you that the growth model is a more refined model of dividend valuation model, and we should use it even if they say dividend valuation model, provided that the growth could be calculated. So if we can calculate growth in the question, we should always use growth model, unless and until the question has specifically asked us to ignore growth. If the question says ignore growth, then we should ignore it, otherwise not. So let's do it now. First of all, we need to find out the growth rate, and growth rate can be calculated through compound interest formula, and we can change that compound interest formula to calculate the growth. Let me show you the formula. This is what you should always be using. S divided by P raised to the power 1 divided by N minus 1, where S is the latest dividend, P is the earliest dividend, and number of years, right? So let's do it. Now, the latest dividend is the dividend that is shortly to be paid, and we need to find out that dividend. So latest dividend will be, the payout ratio is 60%. and the earning per share of the company is 40. So the latest dividend will be 24 cents. Okay. The earliest dividend was 2 years ago, right? This one, 2 years ago, 22 cents. And we should simply ignore the dividend that is paid 1 year ago, because we have to pick the latest and the earliest and ignore all the dividends that were paid in between these years. Okay, so let's find out the growth. The latest dividend divided by the earliest dividend raised to the power 1 upon 2, because the earliest dividend was paid 2 years ago. So there are 2 years in between these two dividends, minus 1, and change the format. It's 4.45% growth. Okay, we are done with one part. Then we need cost of equity. We need KE as well. KE should be calculated using the CAPM model, which we have studied yesterday. So the risk-free return is 4.6% plus the equity beta is 1.4 into market return, which is 10.6%, minus the risk-free return, which is 4.6%. So let's change the format. So the cost of equity is 13%. Now let's calculate market price per share predicted by the dividend growth model. The latest dividend, that is the dividend that is just going to be paid 24, but this is not the next year dividend. So we have to multiply it with the growth, 1 plus G, to find the next year's dividend, divided by KE minus growth. $2.93. 2.93 cents. Let's divide this whole figure by 100 to get it in dollars. 2.93, or up to 2 decimal places, it will be $2.93. This is how we calculated the latest dividend. I just picked the dividend payout ratio here given in the question. Proposed payout ratio 60%, and earnings are 40 cents. So if we take 60% of this 40 cents, we will find out the dividend to be paid. So this is the price predicted by the dividend valuation model, growth model. Okay, now it says something else as well. So why have we have not calculated growth by using the given dividend? Well, if we have the latest information, why should we be taking why should we be ignoring the latest information? The latest information is always the updated information, right? It's always advisable to use the latest dividend figure, because that's the most updated figure, the most updated information. Well, Abdul Aziz, in the dividend growth model, we use cost of equity. And for calculating cost of equity, we have two models, the dividend valuation model and the CAPM. Since we are already using the dividend growth model to predict the price, so we cannot use one formula for calculating two things. So for price, we will still use the dividend growth model, but for the KE, which is going to be used in this model, should be calculated using the CAPM model. not the WACC. WACC is a cost of capital. We don't need cost of capital. We need cost of equity. So if the share price through two methods are different, when one is, which one is the actual and correct one? Well, when you try to calculate price through any formula in the world, that will be a theoretical model, right? That will be theoretical. And theoretical models are always having limitations. So you can't say that this is correct, because when you say, when you have assumptions, the correct word will no more be an appropriate word to be used. So we can say that if the assumptions of the dividend growth models stand true, this is going to be the price. But only when those assumptions are there. For example, there is no capital gain, or people don't mind capital gain, they ignore capital gain, then this price will be correct. Secondly, this price is based on assumption that the dividends will grow at the same rate as they have grown in the last 2 years. So what is the guarantee that the dividends will grow at the same rate, 4.45? This is the historic growth rate, and the historic growth rate of just 2 years. The sample size is too small, 2 years sample size. What if the growth rate is higher than this? Will you still expect the same? No. So the dividend growth model is based on assumptions. So we can't say it's a correct one, but it does give you idea. These models are not considered to be giving you absolute figures. These models give you an idea of how you should be valuing a particular company. $40 is the earning per share, EPS. Okay, now let's go to the discussion. Let's go to the discussion and discuss the significance to Forbes company, how important these figures are for Forbes company in comparison to the current market value of Denoka company. Now, what is the current value? Here we go. The question has already given us its current market price, 3.3 million. Sorry, $3.3, right? So let's calculate its current value as well, which is prevailing in the stock market. We already have a value. That's why it's saying that if already a company has a value, then what's the importance of these two values, the theoretical ones? 3.3 into 5, 16.5 million. So now we have three types of values. Two of them are theoretical values calculated by using formulas which have limitations, and one is the practical value, the value that is prevailing in the market at the moment. So we have to discuss how important these values are, especially when there is already a price in the question. Okay, first of all, my question to all of you. Let's say you are the shareholder of Denoka company, right? And you are a majority shareholder. And one share of your company could be sold in the open market for $3.3, right? $3.3. Forbes company wants to buy this company from you, right? And you are willing to sell the company. The only issue is the price. What price should be there? Will you sell this company for $3.3 per share to Forbes company? If yes, why? And if no, why? quickly. Will you sell this company to Forbes company for $3.3 per share? Ajmal, why you will be selling it for higher than 3.3, and why Forbes company will be willing to buy for more than 3.3 if they can get it from the market at $3.3? Zara, what the reason? I'm looking for the reason why do you think that the Forbes company will be willing to pay you more than 3.3 if they can get it for 3.3 in the market? No, it's the ex-diff price. It's already after the dividend. Forget about the dividend now. I'm not talking about the lesser price. I'm talking about a higher price. Why you as a shareholder, as a owner of this company, be you will be expecting a higher price where Forbes company can have this share for 3.3 from the market. Forbes company can go to stock market and buy a share for $3.3. Why will this company buy it for a higher price than 3.3? No, 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 no. Okay, let me tell you why. See, you people hold a share of a company and you don't know why you should be selling it for a higher price. Let me tell you that why you should be selling it for a higher price. Forbes company does have the option of buying a share from the market at $3.3, right? So it can go to the market and buy it for $3.3. But in from the market, the share that it is going to buy from the market will be minority shares. And against those shares, the Forbes company will never get the control of the company. It is buying these shares from you, the majority shareholder. It is acquiring the company, not acquiring the shares. When acquiring the company will be looking for the control. So how come you can hand over a share for the at the same price at which it is being sold in the market without control? Definitely with the control, with the ownership rights, this share should be sold for a higher price than $3.3. Remember. So if you're in a financial management question, they ask you this question: why it should be sold at a higher price than its current market price? Because of the control. There will be a transfer of control. Okay. Now, 6.5 million. This is the minimum that the owners of the Denoka company will be willing to sell the company for. But this is not the value that they will be expecting from Forbes company. So it goes without saying that this value should not be used. Okay, let's come to the price predicted by the dividend valuation model. Again, this is not going to be used. 2.93, because it is predicting a lesser price than the current market price. And that is probably because the current market price is $3.3. $3.3, which means either, now listen to this, either the shareholders expect capital gain, which is ignored in the dividend growth model, or they expect higher growth in shares in dividend than the growth used in the question 4.45%. Let me increase this growth rate. Let me increase this growth rate to 5%. See, it's 3.15. Let me increase it to 5.1. It's 3.19. Let me increase it further, 5.2. It's 3.2. Let me increase it, 5.2, 3.24, 5.25, 3.26, 5.3, almost getting closer to the current market price, 5.4, 3.33. Here we go, 5.38 approximately, or 5.39 to be very precise. Yes, 5.39%. Either the investors in the market who are buying the share of Denoka company for $3.3 are expecting 5.39% growth in the share in the dividends, whereas the growth model, the dividend growth model, just used 4.45. So let's go back to the original value, 4.45. So one of the reasons why this price is higher is the expectation of the shareholders of a higher growth rate. The second may be the capital gain, because they in the growth model we have ignored the capital gain. Maybe they have considered the capital gain as well. That's why they are buying it for a higher price than predicted by this. But when it comes to the PE ratio, which takes earnings into consideration, it predicts a price of $20 million. And this is probably going to be the price at which the Denoka company owners may be willing to sell this company for. Yes, that may be the price at which the owners of the Denoka company will be selling the company for. So the dividend growth model will be rejected, as it is predicting a lower price than the current market price. The current market price will be rejected because it is without the ownership rights. Therefore, it could be 20 million or probably higher than 20 million. It will be around 20 million. Any questions? Yes, I have discussed the significance, because basically what examiner meant by asking this question is that if a company already has a price given in the question, $3.3, then what's the point of or what's the importance of calculating these values? So I've told them why we should not be using the market price. Even if the market price is there, why we should not be using the market price? Why still PE ratio will be a good way of predicting the market price? Why it is still an important one? Why it still holds a significance? That's what the discussion should be all about. Is it clear, Asad? Okay, anyone else? Well, business valuation. Well, in my assessment, investment appraisal, working capital, business valuation, sources of finance. These 4 areas, I believe they cover 70 to 80% of your slips of weightage. If someone is very good at these 4 areas, he will have no chance of failing the exam. Risk management is there, but it's in the other 20% area. If you are very good in these 4 areas, you don't have any chance of failing the exam. That's my personal judgment. That's what my experience tells. So just put these topics on your priority first. Just try to be very good in these areas. What about gearing ratios? Could you just explain your question? I didn't get it. Jonathan, I did not get your question. Answer only which answer you're talking about. Then which answer you're talking about? We've calculated so many things. Okay. Okay. PE ratio, here we go. Well, we have a question from Ajmal that, sir, which topics will be mostly examined in CRQ? Investment appraisal, working capital, sources of finance. These are the 3 areas where I expect CRQs to be from. Takshika, yes, I shared it on the WhatsApp group as well, and I'll share it again if you are in the WhatsApp group. Otherwise, if you are not, just drop me a text on WhatsApp. I'll add you to the group. When discussing which value will likely be used, is it about best price available to the Denoka share company? For example, if highest price is P, we use that price. No, no, no. It's not about highest or lowest. It's about uh, you should look at both ends. When you're going to buy something, let's say for example, if you have a mind in if you're willing to buy a car from someone, so you have to keep your own potential, your own use in mind, and also the person who's selling the car, you should also keep that person in your mind, what expectations that person has. So you should look at both ways and then come up with a price. So from both ways you have to look at it. Hamza, I have already no, yes, I will share it today. I will share it today. I texted you in WhatsApp, sir, no response. I'm so sorry, Takshika. Maybe I've missed it. Could you just send me a message again? I would definitely reply. Sir, how can I join the WhatsApp group? Well, if you don't have the link, I'll just share my WhatsApp number on your screen. This is my WhatsApp number. Just drop me a text. I will add you to the group. Yes, market efficiency is something that I'm going to discuss in a while. Okay, I hope that you people have noted down my contact number. Yes, why not? Let's take a 5 minutes break. Let's take a 5 minutes break, guys. No problem, Shabazz. I was supposed to give you a break, so no issue. That's funny though. Okay, guys, I think we had enough break. So let's move forward and let's go to the other parts of the Forbes company question. Forbes company has an issue 9% bonds which are redeemable at their par value, of $100 in 5 years time. Alternatively, each bond may be converted on that date into 20 ordinary shares of the company. The current ordinary shares price of the Forbes company is $4.45, and this is expected to grow at a rate of 6.5% per year for the foreseeable future. Forbes company has a cost of debt of 7% per year. Calculate the following values for each $100 convertible bond: market value, floor value, conversion premium. So first of all, let me show you how we can calculate the market value of this bond. Now I'm just uh, giving you a magical thing, and if you keep this magical phrase with you, you will have no problem in calculating the market value of anything, especially the debts. If you have to calculate the price of any debt, you just need to calculate the present value of whatever you are going to receive against that. From a debt, what do you receive? Look at it from a investor's perspective, right? Not from the company's perspective. What do you receive? If you buy a debenture of a company, what do you receive? You receive interest for say 5 years, 4 years, right? So just calculate the present value of the interest payments. And after 5 years, you will be redeeming the debenture. So whatever you get against the redemption, just take the present value of that and add the present value of interest payments and add the present value of the redemption payments. That's it. That's the value of that bond. So you just have to calculate the present value. That's it. Yes, present value of whatever you get is the market value of that debt, right? So if you keep this thing in your mind, you will always be able to find out the market value of any debt. So let's do it here. We have a problem in this type of a question because we have an option. Not we, the investors have option that they can either redeem the bond or they can convert it into 20 ordinary shares of the company. So there's a choice with the investor. So first of all, let's see from the investor's point of view what that investor is likely to be doing. Either he will be converting or he will be redeeming. We don't know. Let's do some calculations to find out. So step one, in a convertible uh, debt, you should always do this step one. The step one is decision. Find out what is going to be the likely decision of the investor. So for that, we need to calculate conversion value first. And the conversion value will be calculated by taking the number of shares available for conversion. How many shares the investor can get against one debenture or one bond? How many shares? Quickly. 20 shares. The investor has a choice of getting 20 shares. Okay. And what is the current price of the share? What is the current price of the share? 4.45. Let me multiply it with 4.45. Okay. This 89 is called current conversion value. That is if the option were to convert it today, then this would have been the value, $89. That's the current conversion value. We don't need current conversion value. We need the value at the time of redemption, right? We need the value at the time of redemption. We don't need the value of uh, the conversion today. We need the value at the time of redemption. So when will he get the choice of converting into shares? After 5 years. So what will be the price after 5 years? This is what we need to incorporate, conversion value. So 20 shares into 4.45 into at what rate the share price is expected to grow? It is expected to grow at 6.5%. So 1 plus 6.5%. We want to see that what will be the share price at the time of conversion. Raised to the power 5. So number of shares multiplied by the current price and multiplied by the growth rate, so that we find out what will be the price or the value at the time of conversion. It is going to be $121.94. Okay, that's the conversion value. Okay, now the investor has a choice, either get this or redeem it. So in that case, he will get cash, which is the redemption value. So at what price it is going to be redeemed? It is going to be redeemed at par value, that is $100. Okay, if you are the investor, what you are going to do? If you are the investor, what are you going to do? Will you convert? Yes, you will convert. So no more the redemption value. The redemption value is no more applicable now. Now what will happen? The investor is going to get $121.94 at the end of 5 years, and for 5 years it is going to get the interest, right? So the market value will be equal to, look at this, the present value of the conversion value, because this is the higher one, and we have to take the present value of this. So we have to multiply it with discount factor, and the discount factor should be of this cost of debt, 7%. We should take this as a discount rate. So we should take a discount factor, because this is a one-off payment. This is a one-time payment. So for a one-time payment, we always use discount factor. So 1 plus 7% raised to the power minus 5. So I don't need to see it from anywhere else. This is what we can do with the Excel. So this will give us the present value of the conversion value. But this is not the only thing that the investor is going to get. He's also going to get interest payments for 5 years. So first, let's see what is going to be the interest payment each year. It's 9%. And 9% should always be applied to par value. Interest is always applied to par value. 9% of $100 will be $9. It will be $9, right? It will be $9. Okay. And now, since this is going to be received every year for 5 years, so we have to multiply it with the annuity factor rather than the discount factor. Okay. And how do we calculate it? 1 plus 1 minus 1 plus R, which is 7%, raised to the power minus 5, and divided by 7%. 123.84. That's the market value of the venture per $100 bond. Walid says it's confusing. Okay, let me repeat it again, right? First of all, what is market value? Market value is equal to present value of interest payments plus present value of conversion value or redemption value, whichever is higher. Whichever is higher, present value of higher of conversion value or redemption value. Remember this formula: present value of interest payments plus present value of higher of conversion value or redemption value. So whichever is higher between the two, we should pick that one. Okay. Let's calculate it now. Walid, just concentrate. Huh? I'm repeating it for you. Present value of interest payments. First of all, the interest payments will be 9% of $100, right? 9% of the par value, $100. So each year we are going to get 9% of $100. What is 9% of $100? The 9% of $100 will be $9. And this is something we are going to receive for 5 years. So we have to multiply it with the 5 years annuity factor to get the present value. So 5 years annuity factor. If you have annuity factor table with you, just tell me annuity factor of 5 years at 7% rate. Otherwise, I have a formula. 1 minus 1 plus the rate, which is 7%, raised to the power the years with 5 years, bracket closed, divided by 7%. That's the formula for annuity factor. So that's present value of interest payments. So let me do it separately for you. Then present value of higher value of conversion cost and redemption value. Here it is conversion value. Conversion value is 121.94. Since it's a single payment, one-time payment, we should multiply it with discount factor 1 plus R 7% raised to the power minus 5, 86.94. Let's add these two, which is 22. That's called your market value. Walid, is it clear now? I hope it's no more confusing. So 1.123.6 or 123.84, it won't make a big difference. You must have used calculator for that and you must have rounded off the figures. So I hope the market value is clear now. Now let's come to the floor value. Floor value is the minimum value for any debenture that has a conversion option. Floor value is the minimum value, right? So what is the worst case? The worst case in this case will be that after 5 years, the investor is going to get $100. That's for sure. This conversion value is expected to be there because it depends on the growth rate that we expect. But what if we don't get that growth rate? What if we don't get that growth rate of 121 and it does not take us to 121.94? The worst that the investor will be getting is $100. So this is the minimum that he will be getting. So floor value is basically the minimum that it's the minimum value of a debenture, and it will always be based on the redemption value rather than the conversion value. So in the market value calculation, we take the higher of these two. Whereas in the floor value calculation, all the calculation will be same, but instead of taking conversion value, we should always be taking the redemption value. Remember this. So floor value, the formula of floor value will be PV of interest plus PV of redemption value. That's the formula. Always this should be the formula. So let's do it. I'm picking this. Okay, let's do it again. PV of interest payments. It will be the same, so I have no change to it. PV of redemption value. It is going to be different. Okay, the redemption value is going to be 100 and into 1 plus 7% raised to the power minus 5, 71.3. And let's add 2. That's your floor value. Sir, there are 100 convertible loan note. Each one has to be. We don't care about how many loan notes are there. We just need to find out for each $100 convertible note. So we have to do calculation for one bond only. Then comes the conversion premium. Conversion premium. Conversion premium is basically equal to current market value of debenture or loan note, whatever the instrument is, minus current conversion value. So the current market value in the question for the debenture is that we have just calculated. That's 123.84 minus the current conversion value that I calculated earlier, 89 point. This 34.84 is the conversion premium. So just look at it. The market value minus the conversion value, current conversion value, 34.84. That's it. Is it clear? If it's clear, then I'll move towards the weak form, semi-strong, and strong form efficiency. It's a very interesting topic. Current conversion value is the number of shares multiplied by the current market price. That's it. The shares available for conversion, 20, multiplied by the current market price. Okay, Janzeb asks that what does conversion premium represents? Can't you interpret now? The current market value of the bond is 123.84, right? This bond has a current value of 123.84. The bond that you are buying today has a value of 123.84. And the shares that you will be getting after 5 years, the shares that you'll be getting after 5 years have a current value of $89. So conversion premium is basically telling you by how much has the value of share, by how much has this the shares have to grow in order to justify your investment. The shares that you are getting, their value has to grow by $34.84 to cover this market value of what you are investing today. This is called conversion premium. In other words, let me explain it in another way as well. Let's say you have given someone a car today, and this car has a value of $1 million, right? It's too much, but it's okay. So it's 1 million, okay? And the person has guaranteed you that he will give you, let's say, a house which has a current value of $800,000, and he will give you this house after 5 years, and the value of the house will grow every year, right? So you have already given 1 million against these 800,000. So by how much this 800 has to grow to justify your investment? Tanzib, how much the value of a house has to grow to cover your 1 million? 200,000, and that's called conversion premium. Okay, so let's start the efficiency now, right? Okay, I'll just explain this with the help of example, but I want an interactive session because I'll be asking questions and you have to answer me, and then you will understand it, right? Uh, let's say you have decided to buy a car. You have decided to buy a car from your friend. Your friend is here. You want to buy a car from him, right? You called him. You called him. You are here now, 5 kilometers away. You are here. You called him and you asked for the price of this car, and your friend told you that he is willing to sell this car for $10,000, right? And you have seen the car and you are satisfied with the price. You think that it justifies the condition. Okay, so now you are moving towards your friend. This car, while you were moving towards your friend, got a minor accident. It got a minor accident in between the time when you were going towards him, right? And the accident is such that it has given a loss of, let's say, $1,000. It has resulted in a loss of $1,000 in this value, right? So tell me, you are here, you don't know about this, you don't know about this. So what price you will still have in your mind? $10,000, right? But the moment you come to know about this information that this car has got an accident, immediately the price in your mind will be changed to what value? Changed to what? $1,000, right? It means the information that investors get will be reflected in the price of the investment. It was $10,000 earlier, now it has reduced to $9,000. This decrease is because of that information, right? And the speed at which this information is reflected in the price, the speed at which this information is reflected in the price is called market efficiency. It is called market efficiency. Now just extend or expand this example to a stock exchange where there are so many buyers, like you are one. There's so many buyers, so many sellers, so many things to buy. So whenever the investors in the stock exchange, in the stock market, get information, their perception about the investment changes, and that change is reflected in the price of the investments. So the stock market price will either go up or come down depending upon the type of information the investors are getting. So the speed at which the stock market reflects the information into the price is called market efficiency. And there are three types of market efficiencies. The weak form of efficiency means that the stock market, the investors in the stock market, they only come to know about the things that happen. They don't come to know about anything that are expected to happen. So once things happen, only then they come to know about it, and only then the price of the stock market changes. That's called weak form of efficiency. That's called weak form of efficiency. You had a weak form of efficiency because the accident took place, then you came to know about this. Then you came to know about this. What? So that's, you had a weak form of efficiency. If in a stock market, let's say there are two companies, company A and company B. Okay, the company's A share price is $10, right? The company's A share price is $10. The company A is is um, is planning to take over company B, and this takeover is a positive one. This is a positive decision. So in a positive decision, what do you expect the share price of the A to behave? Will it increase or decrease? Increase, right? So if the stock market and the investors in the stock market, they only get the information once something happens, it then what will happen is that unless and until A acquires B, there will be no change in the price. Though A has planned to do it, though A has planned to do it, has planned to do it. A has announced as well. A has given in the newspaper that they are planning to acquire B, but not acquired yet. So it is in the newspaper, it is coming on the TV channels, but no investor in the market is knowing about it. They only come to know when it happens. Okay, tell me one thing. Does this sound good? Is it a logical thing? Something is coming on the newspaper, something is coming on the TV, and nobody in the stock market knows about it. So in the weak form, this is what our assumption is, that even if the information is public, even if the information is coming on the newspaper, everywhere it's there, but the news is about something that hasn't happened yet. So nobody in the stock exchange will know about it. This is insane to believe, right? So weak form of efficiency means when the prices in the stock exchange only change when something happens. So now tell me, do you think that a stock market, any stock market in the world, will have a weak form of efficiency, especially in this era of communication? So weak form of efficiency is a theoretical form of efficiency. Remember, weak form of efficiency is a theoretical form of efficiency. In today's world, we are living in an era of communication where communication is so fast. You can just look at the blast happened in Beirut, and the whole world came to know in split of seconds, in minutes. Everybody came to know about that blast. So it's an era of communication. So we can't expect to have a weak form of efficiency. So weak form of efficiency is a theoretical form, not a practical form of efficiency. Okay, what is semi-strong? Semi-strong makes sense. The semi-strong efficiency is when the stock market not only reflects the historic information, but also reflects any information that is not historic but publicly available. A announced to acquire B. It has announced publicly. So the moment the A announces that it is going to acquire B, the share price will respond. And the response of the share price indicates that the investors have come to know about this merger, because prices in the stock market, they change because of the investors. That is called semi-strong. And all the stock exchanges in the world, they have semi-strong form of efficiency because they reflect historic information, they reflect semi-strong of they reflect historic information, they also reflect publicly available information, even if it's related to something happening in the future. Last form is the strong form efficiency, and this is illegal. And what is this? When the whole stock market comes to know about something that is confidential about a company. It's just the directors who have just decided that they are going to take over B, but they have decided not to make this information public. But the stock market, if the stock market, each time when such decision is taken within the walls of a company, they come to know about such information and the share prices respond immediately. No merger has been done. Nothing has been made public. It's just a decision within the company, and the whole stock market knows about it, and the prices have responded immediately. That is called strong form efficiency, which is called insider trading or insider dealing. Someone from within the directors, they are the investors. So that is illegal. And the corporate governance codes, and there's so many laws that prevent directors from buying or selling shares when they have taken such type of decision. They restrict by the directors to buy or sell shares if such type of a decision is going to be taken. So that's called insider dealing. So these are the three forms of efficiency. Now, what is the impact of the efficiency on the pricing? Now, just look at it. Well, in the weak form, what will happen in the weak form? Let's say in the weak form, just look at it. The price of company A is $10, right? And if the merger with B takes place, this price should be 15. Should be 15, right? Should be 15. A has decided to acquire B, right? But A hasn't made this information public. Neither has the merger happened, nor it has been made public, right? So in the weak form, nobody will know that this is going to happen. So the price will still be 10. So anyone from outside the market, if that person speculates, does a speculation that they feel that they have seen A and B meeting somewhere, the directors have met somewhere, so he starts speculating that probably they are going to A is going to take over B, and if it does happen, the share price is going to go up. So he will go to market where the price will still be $10, and he will go and buy this share. And once this merger happens, not once this information is made public, once the merger happens, the stock market will respond, and the price will go up to 15. And this person who bought it for $10 will now sell it for $15, and by selling it for $15, he will gain from this information that he only had through his speculation, right? Now let's come to another part and see from a theoretical point of view. Okay, A has given he has announced in the newspaper that it is going to take over B, right? The stock market is having a weak form of efficiency, remember, right? But A has made it public that it is going to take over B. Stock market has a weak form of efficiency. What do you people think? Will the share price respond? No, the share price won't respond because the information is public, but it is related to something that is to happen in the future. So the stock market will not respond. Now imagine somebody read the newspaper. Only one person read the newspaper. Nobody else in the market has read newspaper. How illogical this is, but let us assume. In the weak form, this is what we assume. So only one person, he came to know about something that was in the newspaper, and he was the only person to read the newspaper. And he came to know that A is acquiring B, so he went to the stock market. He bought the share price for $10 and waited till A takes over B. So when A took over B, the price will go where the price went up to $15, and this guy made a profit of $5. Doesn't make sense. But this is what we assume in the weak form efficiency. So in the weak form efficiency, any person having that publicly available information, access to that publicly available information, will gain from this information. No, this is this is not practical. If you can read the newspaper, anybody else can read the newspaper. So if you won't be the only person to know about it, the sellers of this share will also know that the merger is going to take place. Therefore, when you go to the market, you will already see the price has gone up to $15 because everybody knew it, because it was a public information, right? This is what normally stock market will behave like. Okay, let's assume the practical form of stock market, which is the semi-strong form. In the semi-strong form market, the moment A makes this information public, the stock market will respond. It will immediately respond. So whenever A gives in the newspaper that it is acquiring B, the share price will immediately go from 10 to 15. All the sellers in the stock market will increase this price to $15. So anybody who got the newspaper, he will run to the stock market to buy the share. By that time, he will come to know that share price has already gone up by $15. So he won't gain from this information which everybody else has. And this is very rational. How come you can gain from a piece of information that I already have? Right? So there is only one way. There is only one way in a semi-strong form market for someone to earn, and that is speculation. That is speculation. A hasn't made it public. A hasn't made it public, but has decided to take over B. There is a person called C. He speculated this is going to happen. He went to buy this share, and when they made it public, the price went up and he gained $5. So it's only the speculation through which you can gain. And in the insider trading, no one gains, because the whole market will know that what decision has been taken, even if it has not been made public. So no speculation will work. Nothing will work. Nobody will gain from the stock market. Everybody knows the future, about the future information which is not being made public. That's what is called weak form, semi-strong, and strong form market. Any questions? Do you people have any questions? Bubble in the stock market is basically artificial increase in the shares or the stock markets. So is it clear now? The three forms of efficiency of the stock market? Historic information means information related to an incident that has already happened. It's called historic information. So in the weak form, only this type of information will be reflected in the share price. And share price will not behave or respond to any publicly made information unless until that event happens. Should I move forward? Okay. Let's go to Forex. Well, I'll just give you a quick recap because it's a lengthy topic and it's Not easy to explain in so much detail, but I will try my level best to explain as much as I can. First of all, what is exchange rate risk? Well, if you are in a, if your business is involved in import or export, then definitely uh, any movement in the exchange rate will affect your either cost or sales. So if you are importer, the movement in the exchange rate will affect your cost, and if you are exporter, it will affect your sales, right? So exchange rate risk is basically when you end a transaction of a foreign currency in a way that you make a loss due to the change in the exchange rate. For example, if you have to make a payment after 1 month of, let's say, $1,000 US dollars, right? And let's say it's a foreign currency for you, and let's say $1 is equal to one local currency unit. Now they are equal, right? So it means if you were to make that payment today, that $1,000, you needed only 1,000 local currency units to make that payment. But since you are making this payment in 1 month's time, so you have a fear, you have a risk that the foreign currency may appreciate in value against the local currency. It may become expensive. Let's say you have a fear that it may go up to 2 local currency units. One foreign currency in $1 is equal to 2 local currency units. Let's say you have fear that it may go up to this extent. If this happens, then in 1 month's time, to buy $1,000, you will have to pay 2,000 local currency units instead of 1,000 currency units. And you have to pay 1,000 in addition to what you were supposed to be paying. And this will increase your cost. And this is the risk. And this risk is called exchange rate risk. Okay, can you guys see my screen? Okay. Okay, don't ask questions unless I ask you. Okay, so that is called exchange rate risk. Now, nobody would like to lose anything because of anything. So if you are importer or you are exporter and you are worried about this risk, you will definitely try to do something to mitigate or eliminate this risk. When you try to do something to reduce or eliminate this risk, this is called hedging. Hedging is when you try to mitigate or eliminate the exchange rate risk. There are two broad categories of how you can hedge this risk. That is how you won't be affected by the change in exchange rate. So there are two ways you can avoid this risk or reduce this risk: the internal methods and the external methods. So the internal methods, quickly let me go through the internal methods. Internal methods mean for which you don't have to go to any third party and you don't have to spend anything to hedge this risk. The first method is to invoice in own currency. Let me give you an example. I don't know, you people are well diversified, you're from different type of parts of the world here, right? But you all were supposed to pay in pound sterlings, the ACCA fees, right? So if the pound sterling appreciates in value against your local currency, definitely your cost of the paper will be increasing. And that's the worry for every ACCA student, right? So what if ACCA invoices you in your own currency? you will be free from this risk, right? You'll be free from this risk. Then you won't care where the exchange rate goes, as long as you are paying in your own currency. Similarly, if you are selling goods to somebody who's outside the country, and instead of quoting the price in that company's currency, you quote it in your own currency, and you ask him to pay back in your own currency, then you will not be worried about the exchange rate change, because you will be getting this money in your own currency. That's called invoicing in your own currency. This is one of the ways to which you can avoid this exchange rate risk. Second is matching and netting. What is matching? Let me tell you first. What is matching? Well, if you are importing and exporting at the same time, a better way will be to have receivables and payables in the same currency. For example, if you have to sell something for $10,000, hello, can you guys hear me now? Okay, I'm sorry, there was some disconnection in the internet. Okay, let's, so you can, so matching is when you have a receivable in dollars and you have the same amount of payables in the same currency, you won't be worried about the exchange rate difference or the increase or decrease in the exchange rate, because you have receivable in the same currency and you have a payable in the same currency, and the timings are also the same. For example, in a month's time you are going to receive $1,000. On the other hand, in a month's time you are going to pay $1,000. So what you'll do, the $1,000 that you will receive, you'll straight away use those $1,000 to pay your debt. So there will be no problem. Even if the exchange rate goes up, it won't affect you. That's called matching. And netting is the same thing, but there's a slight difference between netting. That is when you have more receivables or less payables, or vice versa. For example, you have $1,000 that you are going to receive in 1 month's time, but you have to pay $1,200. So there is a difference of $200. So what you will do is you will pay $1,000 out of those receipts, and the rest of $200 you have to manage. So your risk will not be eliminated in this case, but it will be reduced up to $200 only. This is called netting. Last, leading and lagging. Leading and lagging is when you expect the exchange rate to be going up and you are going to make a payment in the foreign currency. What you can do is you can just make that payment in advance. This is called leading. Instead of making it after 1 month, you can make that payment today. And lagging is when you expect that the exchange rate will go down in a month's time and you delay the payment for 1 month, and that is called lagging. So leading means paying in advance, and lagging means delaying a payment to avoid the exchange rate movement. So for none of these payments, you have to go to someone. For none of these methods, you have to spend any cost. These are internal methods, and it will be further clear when you know the external methods. The first external method is forward contract. What is a forward contract? I'll show you in a while. The other one is options, money market hedging, futures, and currency swaps. So let's first discuss forward contracts. Forward contract is a contract in which you agree with the other party to exchange a foreign currency, in future at a fixed exchange rate. For example, you have to buy 1,000. You have to make a payment of $1,000 in 1 month's time. So and you're worried that the dollar rate may go up in a month's time. So what you can you people hear me now? Can you people hear me now? Okay. So when you fix that rate, with the bank, and right, uh, you know right from the day one that what you are going to pay in 1 month's time. So there is no more risk. That's called a forward contract. So now the first feature of forward contract is that it is a binding contract, so you can't escape from it. It's a binding contract. Now let's say where the problem may come. Let's say you planned to purchase or import something, some machinery from somewhere, right? And that was going to take place in 1 month's time. So you went to the bank and you fixed the exchange rate under a forward contract with the bank. Later on, you changed your mind that you're no more ordering that machinery and you don't need that machinery anymore. But you cannot escape from that forward contract. You have to fulfill that forward contract. That is one of the problems of the forward contract, that you cannot escape. It's a binding contract. This is one problem. Secondly, the rate is fixed. Okay, that's something what we are for. Quantity is fixed. You cannot change the quantity as it's a contract. So if you have contracted for $1,000, then you have to buy or sell whatever you have contracted for, you have to buy the same currency or sell the same currency, same quantity of the currency. And the time of delivery is also fixed. For example, you contracted with the bank that you will buy $1,000 on 31st of January, then you must buy on 31st of January. You can't have it on 1st of Feb, or you can't have it on 30th of January. So you have to have executed this contract on the same date. So there is a risk. Maybe what you are supposed to purchase from the international market, the date may change later on, but you cannot change the forward contract date. So that's why it's very important for companies to enter into the forward contract when they are sure of their payment or receipt. Okay, how a forward rate is being set by bank? That's the formula. Remember this formula. It's a very important formula. This is interest rate parity theory, and whenever a bank fixes a forward rate today for a future transaction, this is how it does. Spot rate, that is what is the exchange rate today, into 1 plus IA, the interest rate of country A, the interest rate of company B. Now this is important. Most of the students make a mistake here. First of all, the interest rate parity theory, it helps in predicting the forward rate, right? The one thing, this, remember this. Secondly, is the PowerPoint. Okay, wait, let me fix it. Wait, just wait. Just wait. Hello. Okay. You people can see my screen as well, right? Can you people see my screen as well? Okay, so remember one thing, that interest rate parity theory is used to predict forward rate, number one. Now, spot rate multiplied by the current exchange rate multiplied by hello. Okay, am I audible to everyone now? I'm sorry, I don't know what wrong is happening with my system. Just give me a minute, let me fix it.